and you're trading intern, you're predominantly a buy-side trader. If you're trading red, you're predominantly a sell-side trader. Now, I don't like that because there's a lot of times when the market's rotational and it's blue and you're missing out on lots of opportunities. So the RGL is a very, very good reckoner, and it's something you should absolutely understand, but there is still limitations to these trades. You know, if I was to draw these as implied, for example, as implied volatilities, guess what is also known to everybody? So for example, if I draw, so what I'm going to do, guys, just so you know what I'm doing, I'm going to draw it to the lowest price on the chart, right? So I'm going to draw the middle of the RGL to the lowest price. That's the implied volatility in bonds, right? So what happens is you start using that implied volatility when you see that developing, right? So I can go to the middle of the bond here, and I can see where the implied volatility takes me. Now, if implied volatility is smaller, guess what I do? I reduce the size of the implied volatility in bonds. I bring the implieds down a little bit to there. So then we move into the next day, and I then draw the implied volatility on the next day. And again, this one kind of chops around. You can see it chops from the low price there to the high price there. And I can bring it into the next day, and I can put my implied volatilities here. So you can see that this price stops at the high of the implieds and then extends above it. So we know that implied volatility on treasuries is starting to go higher still again there. So we always look at that and then say, well, what's the implied volatilities tomorrow then? And you can see that the price almost perfectly stops again at the implied volatility. Do you see that? Look at where the price stops. Right on the implied volatility, doesn't it? So when I take that implied volatility again and I look at this day here, where does the price stop? Where does the price stop? Right on the implied volatility. Do you see that? And then it's a little bit higher, so we take it up a little bit, move into the next day. Where does the price get to? Well, it blows out the implied volatility, but it still gives us a starting point for that top edge, doesn't it? It still gives us a starting point to get into that top edge. And with implied volatilities exploding from this day, then of course, in terms of the implieds, we can now look at bonds on the downside from this RGL here and say, well, where's the implied volatility telling us that bond prices are going to go? And from that implied volatility there, we can see that bond prices are probably going to go to 129, right? Agreed? So Mike tells you this every day. Paul tells you this any day. Sammy will tell you this any day. Anybody that does a look at range trading, as in the implied volatilities, or calculates out where the straddle is, the volatility straddles. This is a very easy way to draw these boxes, is just look at the previous day volatility, see what kind of average you're getting, and just know that that's what is normal for this marketplace. And if the volatilities are expanding, the volatilities are expanding. What is this exercise? What is this exercise? What do we call this exercise? This is our pricing exercise, correct? If this is a buy candle from there to there, what's the price of the next candle? Same price, right? Well, that's what implied volatilities is. Do you agree? That's exactly what we did when we talk about pricing up the marketplace. So when I ask you, if I draw in a candle and I ask you what the pricing of your next candle is going to be, what is the price of the next candle? Well, it's going to be the same as this candle. Well, is that not just what implied volatility is? So I would then say, what's the price of your next candle? You're going to take that candle there, you're going to make a trade like that, and you're going to say the next candle is going to be priced at this level here. Implied volatilities. Implied volatilities. Right? So you're using that implied volatility to price up the next candle. Well, you're using the implied volatility to price up the next day. Now, this is obviously based on historical volatilities, because we're looking back over the last 24 hours. Implied volatilities are not historical volatilities, but they have a base for using it, right? They still have a base for using it. There's still a reason why that makes sense. And obviously, if we look forward 24 hours and we can see that there is a big data release coming out, like non-farm payrolls or Fed Powell or something like that, we know the implied volatilities will be greater than they were the day before. So we add that range extension to the implied volatility. We add the range extension to the implieds, and we move the implied beyond that price point. So this is exactly how we can calculate out these things, right? This is exactly what we do as traders. Well, it's exactly what I do as traders. I don't know what you do, but certainly something I do. And, you know, we make those decisions at that point. Crazy, crazy, crazy. We love a bit of crazy.